Hello and welcome to Banking Transformed, the top podcast in retail banking. I'm your host, Jim Marous, owner and CEO of the Digital Banking Report and co-publisher of the Financial Brand. Today on Banking Transformed, we're exploring the ripple effects of the recent high interest rate environment on both consumers and financial institutions. To dig deep into this report from Alkami, we're joined by Mark Lair, Director of Product Management at Alkami, and Jim Perry, Senior Strategist at Market Insights, who unpacked the insights from Alkami's comprehensive 2024 State of the Industry report. This report offers a data-driven look at how higher interest rates have transformed everything from housing and auto loans to deposit behaviors and emerging fintech trends. Whether you're a banking professional, a financial advisor, or simply someone trying to make sense of their own finances, this discussion promises to shed light on the forces shaping our economic future. Higher interest rates and economic uncertainty have significantly reshaped the landscape of financial services consumption, impacting everything from mortgages and auto loans to credit cards and savings accounts. As borrowing costs have increased, consumers are facing more expensive loans and credit, while also benefiting from higher yields on savings products, leading to shifts in financial behaviors and product preferences across various demographic groups. The question becomes, where are we today? So before we dig into the insights from Alkami's new research on market trends, let's hear a bit about our guest. Mark, welcome back to the show. Could you introduce yourself and give our listeners a quick look at your background?
Sure. Thanks, Jim. Thanks for having me. My name is Mark Lair. I'm a director of product management here at Alkami, responsible for our data and insights. I have spent the majority of my career in data. For 18 years, I ran a taxonomy and metadata consulting shop, helping hundreds of companies organize information. And for the last 15 years, one of the spaces that I worked in has been financial institution data, specifically transaction data, which is really interesting. So I'm passionate. I'm a nerd, passionate about digging into the data and looking and identifying trends that can be helpful for financial institutions.
We all are nerds to a bit, or at least try to make friends with nerds that can dig deeper into this stuff than I can. So, Jim, can you share a little bit about your background and your current role at Market Insights?
Absolutely. I will say it's such a pleasure to be with other data geeks because there's so much that data can show us, right? Jim, as you know, I'm a senior strategist at Market Insights. We're a boutique consulting firm. We use customized research and data analytics essentially to help banks, credit unions clarify their choices and find new ways to grow. I've been doing this now for about 20 years. How is that possible? And just love how much things keep changing and keep evolving.
So Mark, let's dig into the report a little bit. How did the process work behind Alkami's telemetry data analysis? How did you collect the data, analyze the data, and drive insights from the data?
So great question. We created a panel of 22 financial institutions, including both banks and credit unions, more than 1 million account holders. And what we do is we aggregate that panel. One of the things we do for those clients on a daily basis is cleanse and normalize their data, so looking at transactions where account holders are making payments. We're looking at their core data as well. And so once we had this panel created, I really just dug in. It's such an interesting time with changing interest rates, a new environment. And so we dug in. I went in with a few hypotheses of what I thought might be interesting. Some of it was confirmed. There were certainly some surprises and some shocking moments as well. But that's ultimately it. It's an aggregated panel of a collection of financial institutions that we put together because we want to keep our finger on the pulse of the trends.
So you're not a newbie to the financial services industry or to the data that underlies that. And you have a lot of customers that ask you to analyze their data for them. But before you get into the individual product trends, What were some of the surprises you found in the data? Did the marketplace react in a dramatic fashion? Was there an impact before was there a big impact, or was it a ripple effect? And did it affect different institutions differently?
It's a great question. I would say the number one surprise, and Jim, you probably can appreciate this. Sometimes the best data analysis tells you things you kind of already intuitively know, but when you put the numbers around it in front of you, that can really be shocking. So when we're analyzing the increase in just day-to-day expenses for auto loans and rent and mortgages, the change in affordability that consumers are facing is incredibly stark. So that was the biggest, wow moment for me. You really think about how much more expensive it is to buy a car or buy a house than it was just 3 years ago.
And in some cases, these are necessities. These are not luxuries. A person has rent, they go up. They can't not rent. Person has to buy a car to get to work, and maybe it's an hourly job, and that hourly wage doesn't go up to the amount that the cost of the car and the interest rate impact. And you as you get into this data, I'm sure you look and go, gosh, I wish I could ask other questions after those questions. So I knew that during the COVID crisis, the COVID loans, that the checks that went out by the government, you saw increases in savings accounts. You saw increases in people stopping their loan payments. They were given the option to stop loan payments for a little while. And then you say, geez, did they stop those loan payments to build up savings as a reserve? Or did they stop those loan payments because they couldn't make other payments? They couldn't live without that money. Those dynamics, you go, geez, it told me a lot, and I wish I could find out more. Jim, in the marketplace over the past couple of years, a lot's happened. I often say COVID looked like a dream compared to the economic environment that came about. And, it's as much the increase in interest rates, but it's also the uncertainty of what's going to happen next. We talked about it before we went on the air today, that it's the doubt that creates as much anxiety. What have you seen in the marketplace from a financial institution perspective, not from the consumer side, because you're more directly involved with the financial institutions, but how have you seen them react, and what challenges are they feeling?
Well, I think, Jim, you probably hear this a lot when you're out at conferences and all the rest too. A lot of bankers are still expressing a lot of concern about the data that they're seeing. Some of them are putting decisions off because of that kind of uncertainty. They're giving themselves a little bit more time to make some critical decisions because they think they have the time, since things are in this kind of wait and see movement. Of course, I'm always out there telling them, you don't have any time. You can't wait and see. You do need to keep making decisions, keep moving ahead. Use your data to make the best decision you can make for today, but look at the trends. And you see that while your consumers are facing some really big issues, what are you doing differently today to actually meet that need that's present right now? I mean, they were so good at pivoting so quickly during COVID, right? Those PPP loans were out the door in record time. Yeah. It proved to so many people, large and small,
what they can do.
Absolutely. But it's like, okay, don't forget that lesson, because you need to bring that kind of agility, that kind of flexibility to keep meeting these needs that are out there that are expressed through the data in this report.
It's interesting, Jim, you kind of mentioned the fact that, they can react, and they're scared about investing too much. But you also, in the underlying comment, said, not every customer's the same. And as opposed to simply putting out a product, there's more and more emphasis on trying to listen to what are the actual real needs of the consumer. There's a lot of organizations that are putting financial wellness programs into their institution, making it more available to find different answers. But it's going to be a matter of, can you combine these concerns that the consumer has with the responses that you can deliver? And I know that from your point of view, you work a lot with organizations to help them do this. One thing that we did see during the economic crisis, the beginning of it, was not only increase in interest rates, but organizations suffering from the lack of ability to keep their deposits. There are some organizations that did quite well. They had a response. They knew what they were doing. They maybe were more aggressive on looking for deposits. From your perspective, Jim, what did you see from the deposit side as far as reactions, and what were the differences you saw between different institutions?
Well, I'm glad you raised the issue, Jim, about differences, because one of the things about a report like this is that it helps us see some big picture trends, some big national trends, but it's always important to drill down to the region or drill down to the market level to be able to really see what's happening in the real world every single day. There were, as you say, a lot of organizations that faced significant deposit runoff, especially for those deposits that were non-interest bearing accounts that there was the most movement there. I think there were a lot of institutions that really experienced a lot of pain, especially leading up to the end of last year. There was so much movement, after Apple and others started releasing these high deposit savings and high deposit CDs and all the rest. It's like there was so much money moving around, and it was really kind of chipping away at those like standard relationships and those deposit balances. Some were better positioned because they were paying closer attention to the data they had about their customers.
So Mark, your report looks into a lot of different products and gives highlights on all your findings. One area was in the housing market, which includes both home buyers and renters, with HELOC originations actually peaking in 2022. Can you share some of the other details that you saw in these trends and maybe your perspective on the impact on consumers?
Yeah, I think the interesting impact on consumers was there was really a twin effect that hit at slightly different periods. But after COVID, we started seeing the average principal balance on originated mortgages continued to increase. For us, that's a proxy for the value of homes. If the mortgage principal is trending up, that would indicate that home prices are rising. So that started before COVID. And then in 2022, as interest rates started to increase, that compounds. So now the higher home values, the interest rates on those home values is significantly higher. And then what we see is the mortgage originations begin to drop. So I think there's a couple of impacts there. One is it's just more expensive. I probably can't afford to buy a home. If I'm a renter, I'm facing increased renting costs. That, as you mentioned earlier, that's a non-discretionary item. I'm stuck. I got to pay the higher rent. I have to have a place to live. If I'm a homeowner, as interest rates go up, maybe I wanted to move before, but boy, I've got a 3% interest rate that's locked in for 30 years. Now moving doesn't seem quite as attractive anymore. That has a feedback effect. Now there's fewer homes on the market. The ones that are, it continues to drive the value up. So what that does from a consumer perspective to bring it into HELOCs is 3 years ago, if I wanted to draw the equity from my home, because equity's been building, it's a good time to be a homeowner. If I wanted to draw that equity, I could do a cash out refinance and to keep a low interest rate. Now, if I'm a 3% rate, I can't access a cash out refinance anymore because I'm going to lose that rate. So that shifted consumers into the HELOC market. So to tap that equity, I'm going to be opening up HELOCs. That, Jim, was something I had bad intuition on when I came into this. I thought, oh, interest rates are higher. People won't be using HELOCs. It's too expensive. They're going to pay them down. It was the opposite, because that was the only way you could tap into your home equity. So people flocked to HELOCs so that they could tap in and do projects, et cetera. If you can't move, you're not happy with your house, you might have to remodel.
Yeah, it's interesting. We're still looking to downsize, but as you said, when the cost of housing goes up and the interest rates go up, I'm sitting here as going, I don't know, on my outlay on a regular monthly basis would change very much if I downsized and my interest rate's higher. I have a lose-lose proposition. It also, what you mentioned about the HELOC also, it maybe also ties into what we're seeing in consumer behavior around experiences. You know, there's been a lot of research recently saying that consumers are spending surprisingly high for experiences, despite an economy that says you would usually cut back on those things. Consumers' behaviors have changed though, and maybe some people are tapping into HELOCs to get, you know, that overseas vacation they've been wanting, but thought maybe they wouldn't be able to do. And it's going to cost more. So it's going to be interesting to see what happens. You know, Jim, from your perspective, how did you see the changes in the housing situation impact financial institutions? How are they reacting? And is it equal across organizations, or are some organizations just hunkering down, not doing much, and other organizations get more aggressive?
Well, interestingly enough, I think housing affordability, of course, is a major issue around the country. I mean, from market to market, you're going to see some areas where banks are doing just fine. They're still doing a number of mortgages because of the profile of their target customers. But higher mortgage rates, rising home prices, lack of inventory, all those things, I think it's kind of a universal pain point for a lot of institutions right now. You know, one of the things that I have seen is that the number of layoffs of mortgage loan officers has started to slow down. And I think because for a while, there was a lot of optimism as everybody went into this year that the worst of this would be over by now. But the delay in rate cuts has really meant that mortgage rates haven't fallen. They're not likely to fall all that much in the near future. And so we're all kind of waiting for that mortgage lending to improve. One of the things, too, that I see from a lot of bankers I talk to, there's kind of an uncomfortable acknowledgement of how the market's really dominated by digital lenders these days. Rocket Mortgage, New Res, all the rest. You know, they're able to offer a competitive rate, but they're having trouble competing on speed, convenience, the things that we know motivate a lot of consumers these days. So, I mean, some bankers are out there deploying new technologies like digital appraisals that kind of help speed up that process a little bit. But I've seen others, especially the smaller institutions, are trying to emphasize service, or maybe they've shifted their efforts to educating first-time borrowers or pre-qualifying people for potential loans when those rates do change. I am really glad that the report talked about the increase in HELOC originations, because I've been cautioning a lot of financial institutions we work with that in this particular rate environment and in the economy we're dealing with, consumers are so rate sensitive that that variable rate that's the key with most HELOCs, you know, could be a problem for people as time goes on, and that could really hurt customer satisfaction levels. So, you know, a home equity loan as opposed to a HELOC or a fixed rate HELOC might have better traction for consumers as we look ahead, because I think everybody's looking to stabilize their financial lives. They don't want to think, oh my God, I'm going to do this HELOC and then that rate's going to like double. Yeah. Yep. So the other thing I want to point out that the issue of HELOCs especially is not just economic. I think a lot of what we're seeing here is also demographic. I mean, you're dealing with an aging population in this country, and especially in certain markets where some of those HELOC originations were from folks, as you say, Jim, that were looking to maybe get rid of all of their credit before their debt before they retire. Yep. Or maybe they were looking to take that great vacation or that Viking river cruise that they've always wanted to take. So I think again, this is another instance where I would love to like unpack that data a little bit more and look at the demographic spread of some of that information.
And the use, you know, yeah, go ahead, Mark.
Right.
Sorry, Jim, I just wanted to weigh in there. I think that is a big value of a report like this, is showing the high level trends and illuminating some things. But every financial institution, I hope it highlights the value of looking at your own data. You talked earlier about where people are moving money, what other competitors they're engaging with, what is it that they like about Rocket Mortgage, et cetera. The data through a financial institution, seeing where your account holders are moving money, the fintechs they're engaging with, that is the best market research you can find. We did some other research earlier this year, not in this report, but people transferring money to Apple savings account, 1 in 4 of them moved more than $10,000. People moving money to Rocket Money, the Rocket Money comes at you with, let's help you cancel your subscriptions, but then they offer you a savings account. Those that started moving money to Rocket Savings, it was small dollar amounts. So there's unique personas represented by the different financial services companies where people are spending money. And that's so important for financial institutions to dive into, to really understand what's happening and how they should respond.
Mark, that is so key. We've talked about that on a couple podcasts, but too many organizations don't have an idea of where their money's going. Their customers' money's going. And so they feel like they still have the lion's share of the customer's business without realizing that they haven't opened up another account or added any more balances to the relationship. But that money is going, as the COVID check, going back to the COVID checks, people said, oh my gosh, look at how big their savings accounts have gotten in our portfolio, without looking at, oh geez, where were the transfers done in the next 2 months, and where do they go? Do they go to SoFi? Do they go to one of the investment portfolios? Where did it go? It's the flow is so important to look at on the deposit as well as the loan side. Speaking of loans again, Mark, on the auto loan side, there were a lot of supply chain challenges during COVID, and interest rates didn't go up quite as fast, but the cost of an auto skyrocketed. Now, that's come down a bit on certainly used autos, but what are the key data points that you saw in the auto loan section of your report?
Same thing, Jim. We saw that the twin impact of the price of cars rising. We saw that in the average loan balance that was taken out for both new and used cars. We saw the interest rates increase. One interesting point was that for just 1 month, we actually saw the interest rates on issued new car loans and used car loans, they converged, which is a little bit counterintuitive. That I don't think that's the advertised rate. I had a hypothesis here that maybe people who are going to be new car buyers ended up going to become used car buyers, so that they got better rates, and maybe there's something happening on the other direction, bringing the issued rates together. I don't know for sure, but that was an interesting convergence. But again, the auto loans are getting more expensive, and one trend we see from that is people are driving their cars longer. So for a data-informed digital banker, a strategy we kind of think about is if 5 years ago, it might be you see an auto loan expiring, you should pitch them a new auto loan. Maybe now the pitch is, hey, take that monthly payment and start to do an automatic transfer to savings. That's different financial strategies than you would see before, because people, they may not want an auto loan. Don't try to give them a new one. Give them something they can do with that money to improve their financial wellness.
It's crazy. If you're out of the marketplace for a car for 4 or 5 years, stark reality of what cars cost right now. I mean, I have a family member that bought a big pickup, but it's not a pickup. But some of these trucks are $80,000 or more. I would have considered that a luxury car, or certainly maybe a sports car, even more than that. But the whole, as you said, the holding on to cars longer, the dynamics are changing underneath that. And again, to find out why a person's even buying a car. Jim, I rail on financial institutions that they aren't listening to their customers, that they don't get all the data in the third-party world that's available. When I do a test drive, a credit bureau hit is done against my account. You can buy the data from who is test driving cars. people don't buy cars immediately yet. When I bought my last vehicle, nobody reached out to me to say, oh, by the way, can we do the lending for you? And basically, I was on social media talking about it. I wrote a check for the down payment. I did everything in the world to raise my hand and say, hey, guys, if you want to help me, here I am. Well, on the other hand, the dealers and the manufacturer contact me all the time because they're using the same data that banks have availability to. How aggressive are the financial institutions that you work with in the automobile lending market? Are they still doing floor plans? Are they still working with dealers? Are they still trying to find the consumers who are ready to buy a car? Or is it more passive, just waiting for them to walk in?
It's moved into this very passive approach. And it's unfortunate because, again, back to the issue of data, they're not paying attention to the data they have about their customers that really helps them know or get a sense of what those customers need relative to autos. Case in point, Jim, you may have heard me tell this story. My own experience, it wasn't that long ago that I paid off a car that I ended up buying. I had been leasing it, but I ended up buying it during COVID because they had no inventory, right?
Right.
So, but I paid that off. No communication whatsoever from the institution that carried the paper on it. Yep. Nothing at all. But because I have a relationship with Chase, that I was actually paying, I was making payments from Chase to that other financial institution. Chase knew what was going on.
Oh, exactly. They knew exactly. Yeah.
And they, all of a sudden, I'm seeing information from them about driving me to their kind of auto market, where I can pick a car through their website, all the rest. And it's like, okay, folks, you're missing great opportunities here by, again, not paying attention to that transactional data. A lot of financial institutions, again, what they are doing is pretty passive. There are a few things they're doing to try to incentivize auto loans right now. Like one of the groups we're working with, they're offering things like no payment for the first 90 days after you get your auto loan, just to give you that little wiggle room to be able to, feel like you can lean into that new car payment, as an example. But the fact that you have the option to actually finance up to 7 years now on some new car loans, obviously, a lot of this too depends on who's your target market. If most of your customers or the customers that you're most interested in acquiring are the ones that have high credit scores and all the rest, you can offer a little bit better rate than you did a year ago. So people are a little more optimistic now about auto loans. But I think everybody's, just like mortgages, everybody's feeling the pain.
It's interesting, Jim, as I mentioned, it frustrates me that data is available. There's multiple vendors out there that'll give you the data, people that are test driving, people that are in the market for cars. To not buy that data and not match it against your customer base and also go as prospecting and not being proactive, if you have a good rate on cars, a person would love to go in and know, oh, by the way, I've been pre-approved for this car already, and not have them go to the finance director to have them try to sell you a loan from someplace else. It's money lost if you want that market. We don't have institutions that have floor plans that are independent. Now right. a dealer, a financial officer is going to get you in a room. They're going to go through their whole computer scene. Okay, how long do you want it? How much do you want to finance? And they're going to find the best player. And when I raised my hand and said, here, I'm buying a car, and ended up not going through the effort of going to my financial institution because they never went to me, I ended up getting a floor plan loan from Ally, and it's a good loan. But that's lost business. So Let's shift over to the other side of the balance sheet on certificates of deposits. Mark, the competition for CDs is obviously fierce, and I think it's been said that 90% of CD balances are scheduled to expire at the end of 2024, which to me was insane. You could give me 50%, I still would have thought it was insane. Can you provide some insight into that and the implications for financial institutions? You talked earlier about transfer of funds and not really understanding where your customers' heads at. What are you seeing in your data?
So that was a surprise to me as well. So when we started to look at the CD market, I think one thing that was very interesting is, of course, as the interest rates started to increase, we saw a spike in demand for CDs. People moved the money. The peak of our CD openings was in Q1 of 2023. Interest rates continued to increase after that, but we didn't see the CD openings increase. And I think it was because a lot of that kind of low-hanging fruit money people had, they put into CDs, and that low-hanging fruit was gone. And so then you get into looking at the duration of the CDs. So that was the other impact we saw of the duration of the CDs declined from... Sorry, I'm going to cheat here. At the end of 2020, the average CD term was about 22 months. And at the end of 2023, it was down to 10 months. So we can do the math. That explains why at the beginning of 2024, 90% of the CDs that people held were going to expire by the end of the year. So now, as a financial institution, CDs are attractive, but it's only locked in for 10 months. I have a huge challenge. We talk about communicating. I need to look at the data and make sure I'm getting in front of account holders when those CDs are going to expire. How do I make sure those deposits stay in my institution? And the theme we've been discussing of being passive is not the way to go. You need to really be there to ask the question, ask for the business, because it's so easy to move money. Consumers are rate sensitive. I think it's a bad experience too, from a consumer perspective. I know financial institutions like to keep their low cost deposits, but it's a good service to say, hey, here we do have a better rate, or we do have something better for you to keep those deposits. That's true service. That's going to help account holders know that you care about them as a financial institution.
So it's interesting, Mark, your report also showed that there's been an increase in overall deposit account balances since 2019. You referenced that a little bit, and there's been a shift in the mix. Could you elaborate a little bit on this changing dynamic of how people are holding their funds and savings?
Yeah, the big shift in the mix that we saw, I think everyone's kind of aware that deposits became flush after COVID and the stimulus, and it started to increase. We've seen that begin to draw down a little bit, certainly. But the big shift we saw was as CDs increased, the balances in money markets kind of went the other directions. I think consumers saw those as substitutes. They didn't seem to mind having to lock up their money in the CD in exchange for the money markets. Now I would hypothesize savings interest rates and money market interest rates are a little bit higher. I'd probably expect to see consumers are going to shift back into those. That may be a reason why we started to see the CD balances decline a little bit. So it's an open market. Consumers are going to shop. They're going to look at the products. They want to get the best rate, and certainly savings, money market, CDs, those may all be substitute goods in the minds of the consumers.
You know, it's interesting, Jim, when I look at this and what Marcus just said, you have CDs that are short. So you basically, every consumer, not just the ones at my bank, but every consumer, 90% of CDs are scheduled to expire, not all at the end of the year, but through the months. That kind of dynamic may continue going forward. In addition, deposit account balances have increased, but I would imagine that many financial institutions are seeing level. It's been level, which means the account balances are increasing, but they're increasing in multiple places. So when you're working with your financial institutions, trying to recommend what they should be doing around their customer base to not only stem silent attrition, but to try to get a bigger share of what's out there today, what are one or two of the recommendations you're telling organizations to do to stop this, geez, there's good news out there, but you're not really part of it?
Right. That's a great question, Jim. You know, obviously, this entire conversation keeps going back to the issue of your data analytics really have to shine. You've got to be able to understand precisely where people are at when they're there, ready for that outreach, ready for that message. One of the things that I'm mindful of, there are some larger institutions right now that are looking to take advantage of some of this churn that we're expecting in the CD market in this next year by automating the processes, using new AI tools, all the rest, to be able to put that offer right in front of the person at the right time to keep that there. Now, you might not be getting 5% or greater like you are now, but there's over the next year or so, it might be 4 or 4.5%. So I don't think we're going to see a lot of movement out of that CD market.
Right.
You're not going to see people moving those dollars back into savings or other investment opportunities because, again, these values are high enough. One of the things that we're saying, this is a great opportunity to make human connection. Take a look at that data. Get on the phone. You've got a lot of people that are just sitting there at their desk during the course of the day.
Yep.
Use your team, use your people to make that connection, to discuss what their options are. I mean, some creative folks out there are offering incentives for customers who retain multiple products. Give them a better rate. Be flexible in what you're offering. Give those variable maturity dates or no penalty CDs, things of that nature. Because it takes that kind of flexibility. There are no one size fits all options here. And unfortunately, a lot of banks are still functioning in that way. They think, okay, we're going to do this to address all these maturing CDs, but we're going to do it across the board rather than personalizing that offer. And I think what's going to signal success for people is the more they can personalize those offers and craft them in a way that allows them to keep those folks, they're going to be in much, much better shape. I mean, there's always an opportunity to cross-sell.
Yeah, we're seeing this too, Jim, that organizations that don't look at their portfolio as when it's going to expire or when it's going to roll over or whatever, but looking at it in the bigger sense and realizing that if I have Jim Perry that has a $20,000 CD that's not expiring to the end of 2025, I can offer him a much higher rate than what we would normally advertise to make it so that the blended cost of your deposit gets in line where the marketplace is now. So I could offer you maybe 6% on top of your 4% you're getting paid on your one that's expiring next year to bring blend. So again, using the data to say, do I have the best opportunity to offer a better rate than I would advertise? These individual rates are out there all over the place. Yeah. The other thing is we have to remember the functionality and the technology that's available now. Mark brought up early that the deposits into Apple savings has been enormous. I would hazard a guess that not only is the interest rate advantageous, but the ease of opening. You have that account opening, very much like their credit card, before you even know it's open. So if you're thinking about it, but you're going through the process, all of a sudden you're going, I just opened my account. It's because it's 4 clicks, 3 clicks, 2 clicks. And we've got to realize that we have to fix the back office to enable us to get accounts digitally. They're not going to come to the branch, but that doesn't mean, as you said, Jim, the branch can't come to them through a phone call or through a text or something like that. I mean, a message from my bank today saying, by the way, Jim, I don't know if you've read the news lately, but there's a good chance that they're going to be dropping interest rates. Want to let you know that now would be the time, if you believe the same, to deposit into a CD and hold these interest rates stable, because obviously the market flows as the market flows. Those kind of conversations are not only very trustworthy and thought to be transparent and makes the organization look like they're not just out for themselves. We're trying to give you a highest rate possible before they change. That goes a long way. So, Mark, getting back into credit a little bit, something that gets a lot of press, getting more press now than it has in a long time, is credit card usage and buy now, pay later. Credit card usage right now, the balance is highest ever. The number of average credit cards per customer is remaining somewhat flat based on your research.
Yeah.
But what it really shows is consumers are tapping into credit for daily needs. What do you see in the data that both between credit cards and buy now, pay later? Because we know buy now, pay later is getting a lot of attention right now from the government. What do you think is going to happen going forward based on what you've seen in the last few months?
So this is another onion peeling opportunity, as Jim mentioned earlier. But generally, we've seen credit card balances. They increased, in using my cheat sheets, 19% since 2020. It peaked at 19% increase from 2020 to 2023. In 2023, we actually saw that go down a little bit. So from an onion peeling perspective, not a lot. It kind of plateaued. I think there could be a couple of reasons for that. One is it's possible there's a segment of consumers who are being a little bit more responsible, looking at their budget, but
have no more. Yeah.
Or have no more.
Yeah.
But this data is looking to be clear. We're looking at the transactions made to credit cards held outside the institution. So to your Amex or your Visa or whatever that credit card might be. So we don't have visibility into the balance. So one of my hypotheses, if we're seeing that average payment plateau or decline, it could be that more people are starting to pay, not pay the full balance. So their balance could be increasing while their average payment is going down. So it is important to engage with those consumers and kind of understand that a little bit more. From a buy now, pay later perspective, I think, again, another onion peeling opportunity. We did some analysis, I think in last year's report, not reflected in this one, where we actually looked at what was the credit card behavior of a buy now, pay later user versus a non-buy now, pay later user. And there were some clear personas that showed up. So the non-buy now, pay later user actually had higher credit card payments, and probably somebody, and was using fewer cards, probably somebody who's using their credit card just to, not as revolving, but just paying it off every month, more that type of persona. But those that use buy now, pay later, their average credit card payment across multiple cards, their buy now, pay later usage actually acted as an additional credit card entirely.
Yeah.
So it's a new form of credit. It's right in your face at the checkout. It seems really easy, but I view it as a big financial wellness concern. I think that it is maybe a new consumer finance kind of dressed up in the ease of fintech. But I think that as a financial institution, identifying that cohort of the buy now, pay later users, looking within your data and identifying the account holders who are making an excessive number of buy now, pay later payments each month. We've seen it as high as 80 in a month at some institutions, if you can believe that, from one account holder. Those are the opportunities. Again,
know your data.
Yeah. That's of course that's an outlier and an extreme, but it's still eye popping. That's an opportunity to be proactive, engage, and give some financial wellness advice, deliver some real service to those account holders to help them understand the risks of credit, which I don't think it's always apparent. We're in this space. We're pretty savvy about financial services. I don't think that's true of every consumer. Financial institutions can fill that gap a little bit.
Yeah. Jim, you work with usually smaller and community banking organizations to mid-size. What's the feel of the marketplace of the organizations that you work with around buy now, pay later and credit cards in general as far as offering those solutions?
One of the things that a lot of community bankers I know are paying attention to the earnings reports from the large banks in the country, that as we're recording this, I think everybody's sitting there waiting to see what those big bank reports actually reveal about credit usage and all the rest. Even though credit usage on credit cards is high right now, I think a lot of folks are still looking at this as a relatively manageable situation, right? It's something that I think it was the New York Fed that had produced a report earlier this year that, to your point, Mark, it's the number of people that are actually maxing out their credit that is raising the most concern for folks, that upwards of 20% of people are at 90% or more of their credit. So as we go into the rest of this year and into next year, I think a lot of people are concerned more about delinquencies or possible defaults, especially for folks that are younger, especially low-income families. There are a lot of people a lot of banks that we work with have been tightening their underwriting standards, especially for those with a real thin credit file or those who are new to credit. So on the one hand, it's really no surprise that we've seen this rise in buy now, pay later. But I think a lot of bankers, they default to this place of pointing out all the risks of buy now, pay later and all of the potential damage it can do to somebody's credit profile. But they're missing opportunities, because when they raise all those risks, it usually prevents them from actually doing anything in this space. And they're just leaving it to people like Affirm and Klarna and others to kind of manage all of that. I think it was probably Ron Shevlin, Jim, that had pointed out with you at one point that said, look, banks are at a distinct disadvantage right now when it comes to buy now, pay later, because Affirm and Klarna and others are they keep placing themselves earlier in that customer journey. So it's not at the end of the sale, it's way at the beginning. Here, we'll engage you now and you can do this. But thankfully, there are tools available right now for banks and credit unions to actually play in this space, to give their customers an option to divide out a payment on those debit card purchases that are eligible for that kind of thing. There's a credit union not far from me that, just introduced that, offered it. There are providers out there, thankfully, that are working with Jack Henry, that are working with some of the core providers that make it easier for community banks and community-based institutions to actually play in this space and give their customers more options to manage their financial lives in ways that work for them. Yeah, there's a possibility that some of your folks are going to overextend themselves. But honestly, for those middle market customers, they're looking for just different ways to manage their financial lives. And buy now, pay later has been one of those options.
Mark, Jim, it's great to have you on the show and talk about this report. The report is going to be available in the show notes. We're going to have a link to the report. I can't emphasize enough the fact that financial institutions, executives, marketers, product managers have to get familiar with this type of data to understand where the marketplace is going and to benchmark yourself against the data that's out there. More importantly, you've got to do something about it. You have to not just read and become familiar with it. You've got to become resilient and be ready for what's coming next. Mark, from your perspective, as you step back a little bit and putting on your financial institution hat, what do you recommend today that financial institutions need to do to get prepared for the future?
Well, Jim, this will maybe sound self-serving to my career, but it's looking at the data. I think you want to become a data-informed digital banker. Yeah. I use an example of when I meet with financial institutions of look at how data has transformed professional sports. And on a baseball field, you see infielders placed in places that 100 years ago you would never imagine that they would be. And that's all based on data. And the data is telling these teams, it's revealing strategies that are going to help them win more games. And if you don't think that can work in the financial institution space, I think you're being very naive and sticking your head in the sand. So really, it's about a transformation of financial institutions being places where we're going to make decisions based on data, and we're going to act based on what the data is telling us. Those are the successes that I see out in the space, and I think are really exciting.
How about you, Jim?
I
know you're gonna echo what Mark said. I know that. So
absolutely.
Exactly.
But beyond that, I think there's a couple of things that I think this report kind of guides us in thinking about. And the first is financial institutions have to keep adding value. So much of what we offer to customers right now comes with this hook, some subtle quid pro quo. We'll give you this if you maintain this many transactions every month. Sometimes you just have to give contextual, relevant information that doesn't come with a sales pitch. Add features, add functions to your products and services simply to help, just help your customers. And then the other point that I think it's so important to recalibrate your messaging and your user experience to express empathy. This tells how important this high interest rate environment's been. It's created challenges for so many consumers. So we've got to create those customer journeys, not always with the product as the end goal, but maybe the end goal should be deepening the customer relationship. Imagine how things would change if that were the end game.
Absolutely.
Yeah. Good point. And I'll add one more thing, and that is that organizations today, to your point, Jim and Mark, you've got to use the data to understand the individual situations of each consumer. Now that's hard. It's not necessarily in place as much as we like it to, but we've got to listen. We've got to find out, as I mentioned earlier, is a person getting a delay in their payment on their mortgage, basically because they can't make it otherwise, or because they want to put money away in savings. We've got to look at the data, as Mark said, the flow of funds, both on the deposit and lending side, to know, guess what? We don't have all this consumer's business. Where else are they doing business? And by the way, you may find out if all the money's going out except a nominal amount, that you have another primary there, and you're secondary. You become a secondary institution without you even knowing it, because nobody has to close accounts anymore. I'll tell a story I've told a couple times before. When I go to a financial institution event, I ask people to raise their hands if they've closed a primary financial relationship in the last 5 years. Maybe we'll get 2 or 3 people, and good reason is a lot of these people are bankers, so they stay at their own organization. I then ask, how many of you have opened a new financial relationship in the last 2 years? Everybody raised their hand. This means that people are going out, even the bankers that work at XYZ Bank are going elsewhere to open accounts. Maybe they're opening an account at Chime, maybe they're opening a SoFi, maybe they're getting an Ally loan like I did. Whatever's happening, it's happening fast, and we've got to react to it quickly as well. So, gentlemen, thank you so much for being on the show. Again, the Alkami report will be embedded within the show notes. So if you didn't notice that when you turned on this podcast, go back and click on the link, and you'll get a copy of the report. Thank you so much for being on the show, guys.
Thanks, Jim.
Thank you.
Thanks for listening to Banking Transformed, the winner of 3 international awards for podcast excellence. We appreciate the support we've received to make this endeavor a success. If you enjoy what we're doing, please take some time to show some love in the form of a review. On that point, we just recently received a review of our podcast from Denver, Colorado, who said, "This is my go-to source of information as to what's happening in the marketplace. I look at it every day to get to know what I need to do next." Thank you very much for that positive review. This has been a production of Evergreen Podcast. A special thank you to our senior producer, Leah Hassage, audio engineer, Chris Fafalius, and video producer, Will Pritz. Until next time, keep innovating and keep transforming.